real estate is a huge part of the economy. So you have a shorter life. And so it breaks it down per IRS guidelines. The way it increases your cash flow is by not paying the taxes to the IRS.
Good morning, everybody, and welcome to Get Diversified. I'm your host today, Jacqueline Landry, and I have a very special guest with me, Bill Smith. So, listen to my introduction of him. He's amazing. So, Bill Smith's Director of Business Development for ELB Consulting. In his role, he helps manage the business development team, coordinates marketing efforts, and serves as a subject matter expert. As an engineered practice, ELB works with business owners and commercial real estate investors and developers to reduce their tax burden and improve their cash flow, all of which we all love. These tax savings are accomplished through cost segregation studies, the 179D and 45L energy efficient building tax incentives, R&D tax credits, and other engineered specialty tax studies. So, Bill, welcome to the show. Great to have you.
Well, thanks for having me. And boy, that baby sound pretty good, but I think that's probably something somebody wrote. And I got to send that to you. But yeah, so we've been doing this for a while, and I like to really help ELB, or been here for over 11 years now. So I've become kind of an expert in this field.
Fantastic. So let's get right into it. I understand that you have a presentation for us.
Yeah,
So
let me
hopefully you enjoy our screen.
Yeah, we'll zip through that pretty quickly and we'll go back to the cameras. I'm all about interaction. It's just us and, questions that you have that you think your listeners are going to want. So, cost seg, here we go. This is just the cover page. So let me just hit page down, click over here. Here we go. A lot of people think it's a tax loophole and it's going to go away. It's not a loophole. It's an IRS guideline. It really came about as a result of the 1986 tax changes. So it's been around for a long time. No one thinks, oh my gosh, it's going to go away. I mean, bonus is kind of waning and we'll talk about that later, but cost segregation and what's called accelerated depreciation is an IRS tax guideline, period. So that's important to know. So what really does it do for the individual? It optimizes the depreciation schedule. So really what you're doing is you're taking, and most people have a general understanding, 27 and a half or 39 year depreciation. You buy it for 3.9 million, 39 years, it's, 100,000 a year. So, or million a year in that case. But what we do is we find different pieces of the asset to short life. And so you have a shorter life. And so it breaks it down per IRS guidelines. They have very specific guidelines for what's called makers right here. Some people think that's bourbon, but makers is also a tax classification system. But you've got to be for profit because it's a tax deduction. You got to have a tax liability and, it impacts, passive income only unless you're using the STR loophole or you've got reps and a couple other things we're going to talk about more later. I know you wanted to hear some about that. So really, what does it do? It's a tax planning strategy. How does it benefit you? Well, it increases your cash flow. And the way it increases your cash flow is by not paying the taxes to the IRS. You're holding your own money and you can keep that money in your pocket. So don't send that money to those rich men north of Richmond, as that famous song came out last year says. So the cash flow really comes from, especially if you're paying estimated taxes. A lot of the investors we have, they're all on quarterly estimated taxes. Those are eliminated or go away completely when you have cost segregation. So that's your cash flow. It's not like once I file April 15th, I'm going to get a refund. And in some cases, that might be the case. But typically, it's like you're not paying the IRS. You have use of that money. It's an interest-free loan from the IRS. And, that's the benefit. And you don't have to have just in the year of in-service. It's best when you buy it to go ahead and get it done in service if you know about it. But we can do what's called a look-back study to reclaim missed depreciation. Oh, I didn't know about this. I bought this property in 2020. Can I still do it? Of course you can. And then the bonus depreciation category that was in effect, you bought it in 2020, would pull forward all your benefits to today. There's some reconciliation. There's a form that's done that says, okay, I took a little bit of depreciation, but you can get all that benefit today without amending old tax. People say, oh, I don't want to have to amend. No, you don't want to amend. So you're looking for a refund. And if you get for a refund, there's the chance you're going to get audited. So that's really something that's important to know as well. So it doesn't have to be just on the year you bought it. How does it work? Again, we break down the components, 39 or 27 and a half, depending on the property type, commercial or residential rental. And then we find 5, 7, and 15-year life classes, 10-year if you've got agricultural information. In 5 years, especially amount of interior components, 15-year site improvements. But what it does here is we're accelerating, or we're taking taking advantage of the time value money. Like $1 today is worth more than $1 tomorrow. But let's go ahead and get those deductions, take our cash now and pay less and use that money for our business, for more properties, whatever we want to do. If you start using it for buying Porsches and things like that, well, that's great. But, eventually there's what's called recapture. You have to pay it back when you sell the property. another way to look at it, and kind of people are like, well, how does that really work, Bill? Is I wasn't great in biology class when we're dissecting frogs in, eighth grade or anything like that. But this is what I came up with a while back, that we were dissecting a building. And so you got your skeletal system, your muscular system, vascular nervous system, all these different components. And so some are straight line, right? The core components, the doors, windows, walls, roof, HVAC, general plumbing and, bathrooms and things like that. But the other systems are where we can find short life, whether it's internal to the structure or external for land improvements. So those become the accelerated components in the 5-year life class, 7-year life class, or 15-year life class. So essentially, we're breaking it apart, redoing your building. If we have plans and specs on construction, we have the exact cost, we do everything like that. But typically, we're looking at, and probably your clients are looking at, and listeners, acquisitions. So when you acquire, we do what's called a purchase price allocation on the acquisition. Improvements are separate. It's always separate per IRS guidelines. We say, we bought this property for $1 million. And so now we have to take $1 million, and let's say the land is 200,000. So we're at 800,000, allocate everything across 200,000 or $800,000, roof, windows, doors, flooring, sidewalks, everything. And so then that's how we allocate per, when we use RS Means, that's a platform, but it kind of allocates to what it's cost to rebuild. So it's construction cost database. So we have to kind of reenact that and reconstruct your building, deconstruct and reconstruct based on life classes and parties. So that's really how it works. The other big thing, bonus depreciation, that changed our world when it came out in February of 2018. It was a look back. It went back to become effective in September 28th, 2017. But it said, one, it added acquisition. So that also was a big component. And it went 100% through the end of 2022. Then it goes down 20% per year. But what does it really mean? So let's say on that $1 million property, we find 30% in short life property. So 300,000 in, let's say, 200 is 5-year and 100 is 15-year. So that $300,000, 100% bonus, you can take that deduction today. Doesn't mean you get extra. It's accelerated. You don't have to take it if you take 300,000 today. Now, if it was, now we're in 60%, this year you take 60% of that 300,000 today, which would be, let's say 200,000. And then the remaining 100 would then be spread over years 5 through 15. And so it'd go through the normal accelerated method, which we did for 16 years for 100% bonus came out. So that's what bonus does. It means how much of your accelerated depreciation can you take in year one? And then the remaining goes over what's called double declining balance acceleration. So it does front load a lot of those benefits, but that's what bonus does and how it works. And there's always some confusion about that.
Let me ask a question here. So, why was bonus depreciation passed? What was the purpose of it for our listeners that may not understand that?
Well, it was part of the Tax Cuts and Jobs Act. And we had a President Trump who's a real estate guy, and he did a lot of things that, like with opportunity zones, and then the Tax Cuts Jobs Act, he wanted to cut taxes. So part of that was bonus depreciation, but it covered a whole host of things: energy tax credits or research and development tax credits, child tax credit. I mean, there's a lot of tax credits and incentives as part of that bill. This was just one little piece. And so what it did, and bonus depreciation has been around several times in the past. In 16, it was 50% only on new construction or improvements. So in the past, it's only been on new construction improvements. What Trump did with the Tax Cuts Jobs Act is made it available to acquisitions. But when it's always been done in certain years in the past, it's to spur the economy. So this was done to spur the economy. Real estate is a huge part of the economy. People are houses and apartments and mobile home parks, whatever. It drives the economy a lot. So it's a big, so that's really what it was, just part of that whole economic tax plan to spur the economy.
And I'll save my next question for a few slides further down.
So, and what depreciation not used in year one, you get all these short life components. It's a carry forward, net operating loss carry forward. I've got an example coming up here shortly, and then we'll probably go, I've only got a few more slides, then we'll go back to just discussion. And let's see, it's past the LLC, offset property. It offsets the income or your real estate. There's some variables there on how you can do it. And here's how bonus is going: 100% to the end of 2022, 80, we're in 60% year today, 40, 20, and then it goes back to accelerated depreciation, which is still very good. We did this again this is how we live for many years on accelerated depreciation. So it's still very beneficial to real estate owners. Now, as I mentioned before, let's say you're doing a property today, you're listening and say, I own this property in 2024, but you bought it in 2022. You're going to get 100% bonus depreciation, not 60% depreciation, because that was what was in place when it went in service, right? Once you start collecting rent. So that's very important. And that catch up depreciation is going to let you take all that depreciation. There'll be some opportunity cost for the past couple of years where you took some of that, but not that much. And it might go back to 100%. If Trump is elected, he'll reinstate the plan. They tried to pass it this year twice. House passed in January. Schumer killed it in August or something like that. But so it didn't pass. And it was a lot. It wasn't just much. There was a ton of stuff in there, but they're just waiting. It's an election year. So we'll see. But if Trump were to be reelected, then it would come back to 100% bonus, pretty sure. If not, then that won't happen.
What's your thought that when bonus depreciation goes down to zero, how many investors like myself and other my peers will kind of get out of investing in multifamily or real estate asset class? What's your thought on that?
I think it's still be even more beneficial. We anticipate when it goes to zero, we're going to see more. We're not saying that, oh, everybody's together business, because now you're hooked on depreciation. You need it. So you're going to get that you still get the depreciation. That doesn't change. Bonus just means what you can get in year one. You're still going to get a huge chunk of depreciation. That 300,000 that I talked about, which you get in year one, but it's going to spread over years 1 through 5 pretty much. So there's still huge deductions to offset income. So like I said, we did this up till 2018 from 2002 for 16 years with no bonus depreciation, except for occasionally on a couple things. So that's really what's going on with that. So I don't see it back. I mean, some people will back off once you're into the depreciation business. I'm kind of like, I joke, I'm a depreciation dealer. People call me every year. I need another hit of depreciation, right? Because if you do it, you get 100 bucks, then you need more because it uses some of that up, right? And so you need more. And so you're coming every year and you're kicking the can down the road. Eventually, when you stop activity in real estate, and you say, I'm going to slow down my purchasing, then you might start doing the 30, tax, having a brain fart on the, like kind exchanges. What's the term for that? I can't remember. I did one even myself, but I'm having a brain fart on that. But so at that point, there's other tax strategies, and that just goes to when you die and you pass on your heirs, you get to step up in basis, 1031 tax exchange. But cost seg and 1031s are essentially the same thing. You're just deferring. It's a tax deferral. And so you're going to have to pay the IRS. You don't get away with it unless you die. And that's what the 1031 does. So when you stop, people kind of put it up in 1031 and it goes into the trust for the family. I got people doing lifetime trust for that, 100-year trust for the kids and grandkids and great grandkids.
So, hey, Bill, I have a question for you. So, oftentimes, I'll tell people about bonus depreciation and what we're doing and the fact that we're not paying taxes legally. And I see the deer with the headlights on. What do you mean you don't pay taxes? When I say we don't pay taxes legally, and, I explain how much bonus depreciation we have received from the passive investments or active investments that we have, and they just don't believe it. So, what would your response be to somebody that were to say that to me again? Help me out with that.
So what we're doing is you say you're leveraging depreciation. As I said, you're optimizing depreciation. And so by optimizing depreciation, that's a huge tax deduction. And it's just like your standard deduction or your itemized deduction, and even business expenses. Expenses are better. If you can expense it first. It's better than depreciation because it comes before the top line, before the net income. But after net income, then the depreciation wipes out that net income. And I've got a little slide to kind of talk about that. It is legal. It's IRS guidelines, as I said. It's not a loophole. It's been going on. It's just let you allow this. But it's like a loan from the IRS because there is that whole recapture thing. So when you sell, what you've depreciated reduces your basis, so that increases the size of the capital gain. Now that depreciated basis lower is taxed at different rates than capital gain rates if it's more than a year long-term capital gain rates. So the answer really is by optimizing depreciation, you can use it as a deduction to offset your income. And so it's really a tax deduction. And this slide actually talking, this is really important because, oh yeah, I bought a house. I want to do a cost seg. So they call me yeah, I'm using this by W-2 income. Okay. Are you doing short-term rental hobo? What's that? Are you a real estate professional? No, I am W-2. I was like, you make more than 100 grand, 150 grand? Yeah. I'm like, it's only going to offset your rent income because it's a passive loss against passive income. And passive income primarily is rental income. But there's royalties. He wrote a book or wrote a song or something like that. There are other things that are passive. So, if your AGI, that's gross income, is 100,000 or less, and there's plenty of investors that do that or are doing and getting the depreciation, you can use up to 24,000 a year. So that's really good. And then between 100 and 150, it kind of peters out to zero at 150. So in a W-2 world. Now, if you're a reps, real estate professional like you, where real estate is your business, or you're spending 750 hours a year minimum and tracked. IRS wants you to track that. And it's more than 51% of your work time you're spending on real estate. Then you can use it against ordinary income, right? Any sale of Apple stock, it doesn't matter. And so what happens a lot, as you know, is you've got one spouse. I got a lot of spouses that's hiring lawyer, doctor, whatever, making $1 million, $2 million a year. And the other spouse says, well, kids are grown or whatever, like we're buying real estate and they're taking $1 million a year in depreciation to offset that income. So on the same return, that's what I have so many clients like that, that's what's happened since 18 going, how can we offset that? So and they have to spend the lion's share of their time. Now, if you have a W-2 and you claim reps, you're going to get audited because IRS says, W-2, 43 hours a week, 2,030 hours a year. Did you spend 2,031 hours a year on your real estate? Not enough time. I mean, very rarely does that. So there's a lot of case studies where people have failed on that. A couple where they've won because they don't work that much. But the other one that's really become popular, and you may have heard of this, is the short-term rental loophole. So it's like rep status junior. So if you have a STR or short-term rental, Airbnb, and you spend, it's got two levels, one at 500 hours, but 100 hours per year and more time than anybody else, and you track, and there's a bunch of other rules about how often you can stay and what you do. I mean, there's a clear level of rules there you got to follow, which I'm doing myself. You can use that passive loss, offset your ordinary income, which is huge. So it's kind of like, so if you have a W-2 and you can take the time, you can manage your short-term rental, it kind of functions the same way. So a lot of people are doing that. And so, but you really have to track that one. You really have to track specifically in rep status. If you're a real estate company, you don't have to track it because that's all you do. You're a real estate company. So those are the kind of key things about that depreciable loss and how you can use depreciation to offset ordinary income. Is that any questions on that?
Yeah, no, I mean, that's amazing. I knew a little bit about short-term rental loophole, but that's not an asset class that we're involved in yet. Seems like a lot of work to me, and I already have the real estate professional status. So yeah, I'm probably going to leave that one alone.
It's not for you, but there's people that, I mean, I'm doing it. I bought a great house up here in the Rappahannock River. I live in Richmond, Virginia, so 90 minutes away. And I've got this ridiculous dock and a freestanding garage and concrete. So I got like 31% of my property just in land improvements. There's all this rock and landscaping and plants. And then of course the house got, the 5-year set, but like 48% of my basis. I mean, that's really good for a
Yeah,
house.
that's huge. That's huge. So that's a great response to, for when people ask me, hey, Jackie, how can I get that? How can I take advantage of this and not tell my spouse he needs to quit his job and become a real estate professional? I can mention short-term rentals as maybe the way that they want to start doing this, right? And eventually have that one spouse potentially, become a real estate professional. So a lot of different ways to skin that cat.
Yeah, no, I've got a lot that are doing that, and they're both W-2s. They've got other rentals, so they're using the passive income to offset on two of the properties, the other three or four. Because if you do it on one property, it can do any of the real estate in your portfolio. So you have this big chunk of depreciation in your W-2, you can't use it. Just do enough to cover the next 4 or 5 years. And so how many properties out of your portfolio need to be done? So I counsel on that, and they're moving towards that. Right? They want to get enough income on the real estate. Then one of them's going to quit, right? So I talk to people all the time about that. So this is just really important about why this is beneficial. And there are rules, and people go, oh, how can you do this? You can't really use it. Why not? I'm like, well, somebody told me. I'm like, they told you wrong. I mean, so I always qualify this. So that's really important in here. And here's the one quick example, depreciation. How does it really work that people ask you? And this is really simple. Okay, $2 million investment, 10%, you got 200,000 in reported losses on depreciation, 10%, let's just say, in depreciation this year. And you had 150,000 in income. So we said my net income, after all expenses, 150 grand. The depreciation I was taking 200 grand. I have a $50,000 carry forward loss or paper loss or net operating loss carry forward. It goes on Form 88, 86 or something. So it's for next year, and it'll go up to 19 years. I mean, so you could have $1 million there, and it'll go up to for the current year plus 19 more. So 20 years, you don't lose your depreciation. And it can also, any unused can be unlocked if you sell that property, and the properties to offset the capital gains on real estate, because that's still a passive income thing on the capital gains there. So that really is helpful. So that just kind of gives a quick thing. It's like you made 150, 150 in your pocket, but you showed a loss. So that's the power that people want to say was legal. It's like, you still showed a loss. And so that's a key thing, just to simplify it in a real basic terms. And of course, it works for any property. I mean, short-term rentals, I do tons of those now. It's really popular. Beach houses, mountain mountain houses, things up in Sevierville, near Dollywood, car washes, convenience, distribution center buildings, a lot of new construction. I do have a lot of clients with that. And I tend to fall into a lot of apartments. A lot of my clients do multifamily. Somehow, I'm a multifamily guy. I've done plenty of auto dealerships, hotels, office buildings. So, and a lot of homes. And as you know, we also have the DIY tool for do it yourself for smaller properties, less than, 500,000 in basis or 600,000 in basis. Some people it'll go up to 3 million. But, once you get to 5 or 600,000 in basis, DIY is a great tool. I'm a believer. I've been on the DIY train from the beginning. We developed that. It's a spinoff company of ours. But it's inherently conservative. It has to be because we're not inspecting it. It's a model. We have to defend you if there's an IRS audit. And so we want to defend it. And we've been audited, we've defended it, and we come out fine. So it's 5 to maybe 10% more depending on the property. So when I talk to a client, I'll look at the property and say, well, your basis is 600,000. DIY will work and do fine. If you're in a hurry, you got to do it because it's basically done in minutes. Do a full study. Let's do the math and what's your appetite for depreciation. 5 to 10% more on 600,000 is up to 60,000 more in tax benefit. For another $4,000, do you need $60,000 in tax benefit? So it's a math. You want to use DIY, fine. But if you're looking to mine the most depreciation, 30 to 60,000 more, or sometimes more, and of course it's the features of the home. And I look at the property and say, it's pretty ordinary. I'm like, ain't gonna help you that much. So just do DIY. But if it is, there's a value proposition for DIY. I counsel people on that. So it's very important to know that. So that, again, it does pretty much everything. And then the final one, a shameless plug on ELB. We've been doing this since, 2002. We defend studies in the venture audit. As long as you own that property at no additional cost. We've done 15 to probably 16 plus thousand now. We have billions of dollars worth of tax benefits. We're very focused on project management for engineered studies. And our methodology is what really matters. And this is what this talks about. Fully engineered and accounted methodology. A lot of our competitors use modeling, which is what DIY does, and then they blend in a little bit of engineering. You call them engineering-based studies. Well, we're fully engineered and accounted, so we look at every component and give them all equal treatment. So that's what sets us apart and why our studies tend to find more than most of our competitors who cherry-pick the easy stuff. So that's kind of my quick talk.
Hey, Bill, could we go back to the one slide with the different asset classes? So one of the things that one. Yep. So I see self-storage, 20 to 80%. Talk to me about why that's one of the highest percentages of the
They're fantastic. Well, you get the old-fashioned traditional self-storage from 20 years ago. This is a bunch of concrete garages with roll-up doors and the fence and stuff like that. They're going to be more in the 20 to 30% range. They're going to be lower. Now, you got some demountable walls between. You got some different things, some electric in there that counts. But then when you get to the conditioned self-storage, where you got a multi-level conditioned building, air conditioning, which is a straight line 39-year property for commercial or 27 and a half in residential, the air conditioning in the storage area is 5-year property. That's huge. It's big money. Where in the office, right? You got an office, it's still straight line property. And some of them have wine cellars and they have all these ridiculously improved things. They'll have special security and fencing and lighting and ways to get in. They'll have deep concrete for trucks to back up into there. So they can really do well. So with the conditioned storage does very well. Some people have a combination of like a conditioned building, then they have some other the garage. So I do a lot of those with clients, and a lot of my clients will buy an old Kmart or Target or something like that and are converting them, or even a warehouse. They got clients buy a lot of warehouses and do self-storage conversion. So that we have to do the PPA, right, on the purchase, and then all the improvements, I did one recently, just bought it for a couple of million and spent $5 million in improvements, so we did that. And that was a great, once it went in service, we were able to do the study for them. So self-storage is good. And it just depends on the characteristics of the property as to what and how high it can go. But it's one of the top ones.
Awesome. I'm invested in a self-storage conversion deal. So had a building, right? Kind of like a Kmart, but it wasn't a Kmart. And we're converting it into self-storage, getting ready to go live here in the next few weeks. So
we'll learn to help you out with that.
We'll have to reach out on that one in specific. And then just kind of wanted to talk about your tool a little bit. So when Bill said that it was really easy to do and you could get results in minutes, I'm a user of that, right? So we buy a lot of anywhere from single families up until to 8 units. We buy in opportunity zones. So right away, I want to get in there and plug in my numbers and boom, get a report out and send it to our accountant. And then what we do is we come back and we do the improvements only to get some additional bonus depreciation. So really, really love that. I encourage everybody to use that. When I mention it to people, they go, "Where's the tool? Can you send it to me?" So I'm sending you lots of people, Bill, because it's just really great. And it's good to know that you guys are conservative because you're not out there actually going and inspecting the building. So I love love that, and I actually didn't know that you were conservative on that front. So great to know on that. And but let me ask you another question.
There's a tool right there. There it is right there. I just brought it up just to show just DIY cost seg.
Yeah, it's awesome. So you can see there the prices way less than what you would do for a traditional like large 100-unit apartment building, right? So you're looking anywhere from, 400 up, $2,500 where and you can get thousands of dollars in bonus depreciation.
I help people with this a lot. People I step them through. It's real simple. The screens, or we concierge you. You want our team to do it for you. You basically just fill in these screens where you got to put purchase. Let's say purchase. You fill in these screens and some other things build up, and then you can actually test your results. And then we provide audit support. It's optional. I always recommend people get it.
Yeah, I get it as well.
But that's DIY.
Yeah. So, Bill, why, oftentimes when I'm telling investors about this bonus depreciation loss and, you could pay less taxes, they said, why doesn't my accountant know about this? So, tell me a little bit why a lot of accountants out there just don't know about bonus depreciation. What are your thoughts on that? Are they just uneducated on this topic?
They usually know about it in general, but if they're not real estate centric and don't have that, because usually they have like a niche or specialty, and they're usually tax preparers. So if you have a tax strategist, they're going to know about that. A tax preparer is just filling out forms. If you bring it to them, oh yeah, there's depreciation, we can do it. They go, well, they had a bad experience, or they have a misunderstanding about it. So it's not their fault. I mean, a CPA, typically a tax preparer, is like your general practice guy. You go in there, turn your head and cough, that kind of stuff. What's your vitals and that. And then if they go, ooh, there's a lump, they're not going to take you to surgery. They have a expert. So we're the expert.
Right.
So I work with tons of CPAs. So they send me the business, say, this guy has this need, he gets this building, help him out, see if we can do some benefits. So it's not their fault that they don't know. And some might be against it. They're like, oh, it really doesn't work. And then I've had many CPAs that then they poo-pooed it. And then I've shared with them the results. And they go, oh, well, why wouldn't we do that? I'm like, yeah. And they go, oh, they just had a misunderstanding or misperception. I don't know that much about it. So, and then they become like fans, and they're sending me all kinds of clients. So, it's not their fault. It's just not their world. And they focus a lot of times. Now, if you have a tax strategist, there's certain firms that really do that. They'll look at that. And there's some that are specific to real estate. So as I'm sure your firm is a real estate expert. And so that's really important. I work with a lot of those, but some just don't know. But once they understand, they get it.
So for all the listeners out there that are thinking about, this and their accountant says, I have no clue, you may want to think about getting a strategist, switching accountants that have a little bit both of those characteristics from a strategy standpoint.
I tell people to switch accounts all the time. They go, I said, well, you should look for a new one.
Yeah.
Even if it's your best friend from high school and you play golf, you see your buddy, it's not as well. If you're going to be in real estate, you need somebody that understands what you're doing. If it's your goal, it's not a knock on them. It's just not their expertise. They may work with doctors or different kind of people, or so they have a niche, or they're just tax preparer.
Exactly. And me being a realtor, Bill, I didn't know if you knew, but I'm also a realtor, and I talk to a lot of realtors that are in my position. What a wonderful position to be in. They have the real estate title, real estate professional title. Do some of them do it part-time versus full-time? Yeah, that's another story. But I'm like, why are you not taking advantage of this thing called bonus depreciation if you have the excess money to be able to passively invest in real estate or self-storage or whatever, mobile home park, anything in real estate? And that's a pretty unknown topic too, from just realtors that just don't know that they can take advantage of that. So it's just really not a well versed or talked about topic.
I want to make one quick correction for you. Just because you're a realtor doesn't make you a real estate professional. You have to have this and you have to have a permit. Now, part of those hours in your realty business qualify for that. But for other people that they might not know that, you don't have to be any realtor, any license. You just need to be an active participant in the 7 activities to get real estate professional status. You don't need a realtor license. You don't need a contractor. You just need to be a participant. But as a realtor, some of those hours will qualify, and it helps. And you would absolutely want to do that, like you're saying. But just because, well, I'm a realtor, so it's like, yes, you're a real estate professional, but as the IRS sees it, you're not. I mean, the title thing at the bottom of it, but that's one of the things that I think people get confused on sometimes. It's like there's rules for those hours, and have a big document about how to qualify for that, which is like the real estate CPA. So that's what they do.
So out of the top of your head, do you know the 7 areas that qualify you for being a real estate professional?
Not the top of my head, but I got a PowerPoint. I did research for my team to do that. It's management, operations, transactions, sales and acquisitions, and there's I know you do. So why don't you share with people what they are? 'Cause I can look it up, but I don't know.
Yeah. So I don't know them exactly. So that's why I was just asking. But I know there's a lot of
Momentarily.
yeah, there's a lot of different activities that will qualify for that. So, just thinking off the bat, there was somebody I sat next to at a conference. They were they owned and operated a construction company. And then somebody said, well, I think that qualifies you as a real estate professional. And he goes, it does? So kind of thinking broader outside of the real estate professionals being a realtor, right? You got to kind of think about all the different 7 areas that you're talking about.
I pulled it up. There's actually 11. Come over to there's development and redevelopment, construction, reconstruction. So let's kind of roll up into 2: acquisition, conversion, rental activities, operation, management, leasing, and brokerage. So those are the 11 criteria that is what's called real property trades or businesses. So those are actually the trades or businesses you can be in those. And then in there's actually activities. So I don't actually, the activities are the things I need to put in there, but those are the real trades or business. But there are 7 activities that are part of that. But those list kind of the activities as well, because you're in the management, you're in the operations, you're in the acquisition. But those real estate specific types of trade, that's what the IRS defines. So actually 11: development, redevelopment, construction, reconstruction, acquisition, conversion, rental activities, operation, management, leasing, and brokerage. So I just did something there for training for a team because I want to make sure that we can share with people. If they think they can get it, they can't. I'm not going to sell them a cost seg that they can't use because they're going to be mad.
So are you the right person to talk to when it comes to wondering if you're if you can have the title of real estate professional, or is that more like your accountant?
It's probably your CPA. Yeah, I'm not a CPA. I play one on TV. I know a lot about it. I know more about cost seg than probably 98% of every CPA because they just don't know it. That's not their world. And that's fine. That's not supposed to be their world. So I counsel a lot of even some of the real estate CPA, they ask me questions. Sometimes I'm like, wow, you guys are asking me? That makes me feel good. And we have an expert on the back of our house that does masters of taxation that's been doing cost seg for 20 years. So I'm pretty good at that, but I have a document. So I can say, here's the kind of qualifications. Like when I talk to people, what are you doing? How are you doing? I have the fundamentals, but then I have a document that I share, it's a pretty big, say, if you want to do this here, you got to do this because it's strict. Unless you own a construction business or real estate business and you're buying and selling and managing properties and you've got a LLC or a business that actually is a real estate business doing these things, kind of do it on your own in an LLC, then you need to track it because if they audit you, you have to track it. And the people that say, oh, I spent, hours writing checks. You wrote 3 checks. How can that be 3 hours? That doesn't qualify for salary. So they wipe that out. So you've got to be legit on what you do and the time you spend. You need to track if you're in a business that needs to track it because if you try to make it up and the IRS says, hey, you're getting audited, they'll know. I mean, it's, you just make it with picking dates and doing the activities. And it's very important to stay on it if that's what you're going to do. Unless, like you have a real estate business, so you don't really have to do that. So there's a criteria where you don't have to or you should. Like you're that spouse that's doing it, you better be doing it. Like,
Yeah.
if you're in
Absolutely.
business, but not. So.
Absolutely. So, Bill, I know that you had up there before where people can find you, but they probably didn't write it down. So, just verbally tell people where they can find you if they have any questions on, cost segregation studies, bonus depreciation. Where can they find you?
Okay, they can call my cell phone. I just use my cell as my business phone. It's an Arizona number, but I live in Virginia. It's 480-747-5547. That's 480-747, like the airplane, 5547. And then my email is bill@elbcostseg.com. And I'll pop that up on the screen. Bill, Bill Smith, spelled just like it sounds, bill@elbcostseg.com, and then 480-747-5547. And if someone asks you, I'll send you this little slideshow that you can share. It's a PDF. You can pass that on. If someone says, hey, I want to see more about that, I'm happy to. I created that for you. So
Awesome. Well, I appreciate it, Bill. Thank you so much. And I'll continue to push business your way as we see fit. And I really appreciate your time this morning, and we'll be in touch. Thanks so much.
Rental rates are increasing because there's so much more money in the marketplace. 2 to 3% was sort of the traditional rental growth that operators were comfortable projecting.
Jacqueline and Melvin, thank you so much for taking time out of your busy day to listen to this episode of Get Diversified. Please make sure to subscribe to our podcast so you don't miss out on future episodes. Finally, stop by our website and follow us on social media. Ciao for now. Make it a great day, and we'll see you next time. And remember, get diversified.